If you watch just one video on investing this year, this is going to be the best one. Have you ever wanted to have all the options as far as investing in one video where somebody just kind of goes over everything in an overview type format so that you can have it all in one place to refer back to at any point? Well, I made this video for you, and I'm going to go over a bunch of different topics in the investing world, give you some pros and cons and just some things off the top of my head as far as what I think about them. I'm not going to be going extensively deep into each one of these things, but I have made many videos on my channel that do go deeper into each one, but this one's going to give you an overview, and I'd love to hear what you think about the topics. I'm going to discuss a lot, but some big ones are going to be stocks versus ETFs, full world investing versus just USA investing, real estate, retirement planning, retirement and withdrawal strategies, taxes on investments, and just how much you should invest in total. My name is Nolan Govea. I'm a university professor with an MBA and have finished about half of my PhD. I've been investing for about 12 years and have been heavily researching in the world of finance for about 18 years. I've started, run, and sold many businesses. And I just make it my goal to simplify this complicated world of finance here on YouTube. I don't ever ask for a like or a subscribe because I kind of think it's a little bit cringe. But if all that resonates with you, go ahead and like and subscribe. Now this video is going to be much longer than most of my videos, but it's going to be packed full for you. I will have subheadings down below so that you can click to whichever topic or whichever one that you feel that you need the most, and so that later on, after you've watched this whole thing and you want to go back to specific ones, it's going to be much easier for you. I'd highly recommend that you watch all of this video, even the parts that you think you already know, because I'm likely to go over something or say something in a perspective that might be a little different than what you know. You guys are in for a treat because I got my sidekick Basher here ready to help me today, so let's talk about investing. So the first thing we need to figure out is how many stocks or ETFs should I even have in my portfolio? What's the perfect number? Is it something like 43? Should I have 100 different stocks? What's going to be best for you? The big thing that I try to get across to people is that at the end of the day, investing should not be complicated. You shouldn't have so many positions that when you go back and look at your portfolio, it stresses you out. Now, some people are totally fine having 30, 40 different types of stocks, and they feel okay because they know about each and every one. But for the vast majority of people, we understand and know a lot about maybe 5 to 10 different companies, if that. And so what I try to do is tell people have as little as you need, and for some people you can have as much as you need, but for the vast majority, what I suggest is something between 0 and 10 individual stocks, and in between 1 and 5 ETFs. I'm going to go over ETFs in a second, but one big thing that I see that's a problem with some people's portfolios is they have 10 or 20 different ETFs trying to over diversify, but what's happening is you're kind of investing in the exact same thing, just from different companies. So I'll explain that in a second. Very quickly though, the answer to that question is, it really depends on what you care about. Do you care about having a company in each sector? And do you care about researching each and every one and kind of doing this as a hobby? Or would you rather just have it be as simple as possible, getting the market return or better, beating inflation, and growing your wealth? Figuring out what you actually care about is what's going to help you answer that question. Next, should you have a financial advisor? For some people, yes. If you don't want to do any research, if you don't care about finances at all, if you just want somebody to help you be able to invest, get some returns, make some money, make some profit, and you didn't have to do a thing at all and you really don't care, then fine. Yes, it's better than you just putting money into something that you heard was a good investment and you have no idea why you're investing in it, and then it just drops sharply and now you just lost your money. The problem with financial advisors though is that some of them are just very, very smart. If your portfolio looks something like this, which most portfolios look like this when they're being managed by somebody else, what they've done to a certain extent is try to complicate it as much as possible so that when you do look at it, you're going to feel overwhelmed. You're going to think, I can't manage all of this, so I'm just going to keep paying this person to manage all that. Which is why I go back to the first thing that I talked about in this video, which is to simplify it as much as possible. The problem with some financial advisors or money managers is that you're paying a percentage of your portfolio, not just the profit that you get. Not just the amount that they make you, but in total. If you put in $100,000 of your own money, you're going to be paying a percentage of that forever to this person. And that doesn't really make sense, especially if you can just understand the very simplified type of portfolio that I go over on this channel. This is why I started my private financial coaching business, and I've helped over 200 people try to simplify their portfolio. And the big thing that we did is make it so that you're not having to pay $1,000 to $5,000 per quarter to have this financial advisor make your portfolio. You can definitely do this yourself, and I've seen so many people take back their financial life, basically, by understanding just a couple of positions, 3 to 5 different things that they have to research and figure out. At that point, they can then manage their own portfolio, and they're not having to pay a couple $1,000s a year for somebody else to do that work for them. If you're interested in private financial coaching, go ahead and email me at ProfessorG.invest@gmail.com. All right, let's talk about stocks. I know that you know what stocks are, but they're basically a way for you to invest in this type of company. So let's say you like Apple. You can invest in that company by holding that stock. Or if you like Nvidia or CrowdStrike or one of these other ones. The pro of holding that stock is that sometimes these stocks can go up way more than the rest of the market. Like Nvidia's gone up like crazy. And so people can get pretty rich investing in just that individual stock. The cons, obviously, is that whatever can go up fast can obviously go down fast. If you just invest in like one company, you put all your eggs in that basket, that company doesn't do well for a little bit and misses their revenue or misses their profit in some way, that thing's going to drop and so will your portfolio. Individual stocks are great for some people, but also for most people, I don't even recommend that you have any individual stocks. You do need to stay on top of it. You do need to do research. It's not just enough for you to buy it and say, I'm just going to hold this thing forever no matter what happens. That's not the strategy with individual stocks. Because if you did that with Sears or you did that with any other company that's gone all the way out of business, you're not looking so hot. Now on the other side, there's something called index funds or ETFs. Both of these are somewhat synonymous. I'm not going to go too deep into what they are, but basically it's like holding a basket of stocks. So instead of just holding Apple, you're holding Apple and Microsoft and Tesla and Berkshire Hathaway. And so let's just say that Apple did drop. Well, it is a part of your portfolio, so your portfolio will drop somewhat, but since you have those other stocks within the ETF, that's going to make it so that your portfolio stays relatively stable. Like, yes, it's going to drop some, but it's not going to be catastrophic. There's different types of ETFs as well too, and they kind of vary based on risk. So there's some that are incredibly broad, something like the total US stock market or even the total world market. There's also like the S&P 500 or a broad growth ETF. And those are the ones that I personally like to stick to, especially for a core of someone's portfolio. There's also things called sector ETFs, where you invest in an ETF that has a bunch of companies in energy or financials or healthcare. If you really think one of those is just going to go to the moon, then you might want to have a little bit more of that. Right now, a lot of people really like anything with AI and semiconductors, and I can see why. The main thing with these, just like with stocks, is that the more specialized that you get, the more risky it is. Because if you have a broad sector ETF, something like the S&P 500 or maybe even the total US stock market ETF, if one sector goes down, let's say healthcare just really takes a dive, the rest of the sectors in that ETF keeps you pretty safe. Whereas if you invest in just a healthcare sector ETF and you think you're somewhat safe, but then healthcare for some reason really dives, that's really going to mess with your portfolio. Now, Basher specifically said that he wanted to be in on this next topic because he's very adamant about this. And this one's all about how much do I need invested in order to retire? And this is just so important because when I talk to people and I see how much they're putting away for retirement, especially if you're 20, 30, 40 years old, that retirement isn't happening for some time. So is it fine for me to put away $200 per month, $500, $1,000? What are we actually investing for? And so that's what you need to figure out. You need to figure out basically what type of expenses do you need covered and when would you like that by? For some people, having $1 million when you're retired is more than enough. For some people, having $100,000 when you're retired is more than enough. And for some people, you need $10 million. But it really comes up to what is it specifically that you need and what do you need covered? Did you have something to say? So Basher just reminded me that you want to make sure and understand what your living expenses are now and possibly what they're going to be when you're retired. If you need $10,000 a month in order to live a comfortable life, then you're going to need $120,000 in retirement each and every year. So you're going to need to have enough invested to be able to withdraw that amount from your investment accounts. If you only need $2,000 a month for you to be able to live comfortably, then you only need $24,000 coming from those investments, and that's much easier to figure out. The other thing to keep in mind is you're probably not only going to have things like your 401k or your IRA, you're also going to have things like a pension. You're going to have things like Social Security. You might have rental income from investment properties. You might have business income from something that you stepped away from but you invested in and it's coming in monthly. There's so many different things to keep in mind, and so you don't need to stress yourself out too much needing a certain huge number from any one investment. The main thing that you need to do or figure out at some point is, number one, what are your living expenses now that you need to cover? What are your living expenses possibly at the time that you think that you'd like to retire? And what type of income can you expect coming in at that time? Later on, I'm going to talk about how much you need to invest in order to hit some of those goals. But for now, you do need to know those numbers. You need to understand your own budget. At the very least, what's your income now, what's your expenses, and how much delta between the two do you have to be able to even invest at some point, and then just do your best to not spend all that money. All right, next is growth investing versus value investing, and I'm going to do that one on my own. So growth investing versus value investing is definitely a comment or question that you guys definitely love to give me down in the comment section, and people like to weigh out which one's better. Now, growth investing is when you're investing in either a company or ETF and things that are supposed to grow a lot faster than normal. Think Tesla or Nvidia. Any of these ones that are new technology, very exciting, lots of hype, and should go to the moon. And that's the pro of growth investing, but the problem with growth investing is that more often than not, these companies are the ones that sink very fast, so they're very, very volatile. Then there's value investing, and value investing was big by Benjamin Graham and even Warren Buffett. The idea here is that you're investing in a company or ETF, something that's definitely a little bit more stable. It's a little bit possibly more undervalued as far as when you're investing into it. It's something that maybe gives you a little bit more margin of safety. They're definitely not going to be exciting type companies, but they will be ones that should stay pretty stable. They'll go up a little bit. If the market drops, they'll only drop a little bit. It's ones that keep your portfolio pretty sustainable. Now, obviously, which one is best, again, comes down to your temperament. It comes down to what you care about, what you want, your time frame, your risk profile, all these types of things. For some people, having a 50-50 split is a great move. For some people, having only 10% in growth and 90% in value seems like something that's going to help them sleep at night. For some people, they can go 100% growth and be totally fine because they have safety in other areas of their portfolio. Again, a lot of this comes down to you personally, and so that's what you should be doing when you're watching these types of YouTube videos or doing your own research. You should be putting together your own thesis on your investing. That's why I always talk about in my videos that you should do your own research. That all started out for you by giving you some of my thoughts and some things that I've figured out, but you should just be investing based on what you think personally. When I think of growth investing versus value investing, or just all the different types of investments that you can invest in, I think about the Olympics that are going on right now. Each one of those athletes are amazing, and each sport is tough in its own way and fun to watch in its own way. And we like different ones for different reasons, but we can't just sit there and say one sport is better than the other or one athlete is better than the other, because they're different and they're doing different things. So figure out why you need whatever it is that you need in your investments, and then we can go on to this next section. And this next one is all about the whole total world investing versus just investing in the United States. And this one's a hot take that I've taken a couple times on this channel, and I think that you need to listen up. Back in the day, it made a lot of sense to invest in different countries specifically. Back in the 60s, 70s, 80s, in order for a company to sell to a certain people group or people within a certain country, they had to be in that actual country. People had to walk into the store and buy whatever the thing was, or go door to door in that town. And so originally, when this investing thing started to get bigger and bigger during that time period, it was important for people to diversify by having a little bit of international stocks within their portfolio. And again, that made sense. You want market share from other parts in the world, not just this one country. Then in the 90s and early 2000s, the internet really became a thing, and it's grown like crazy, obviously. You're watching it right now. What really happened though is it took borders away, especially for companies specifically. This little thing called globalization happened, and it made it so that companies can sell to anyone, anywhere, and you don't actually have to be there. People are buying things from Amazon from different countries. People are buying things here in the United States from China off Alibaba or Temu or any of these other ones, because it's not limited to where your country is. Amazon and a lot of these other companies have literal divisions of people that watch for what's happening out in the rest of the world. If some place out in the world has some cool product and it's starting to gain a bunch of market share, it triggers something in these companies that have a lot of capital, and they just go and make the same exact thing for a little bit cheaper and offer it over there and pull the market share from that country. So investing in something like the S&P 500, which is all United States, but it's the largest 500 companies within the United States, is just always going to be such a smart idea, because now we're not limited by borders and we are buying and selling from everywhere in the world. I can definitely see why people would want to have some diversification within their portfolio, and if that's you, great, go for it. But I just want you to look at the data. I want you to look at how much it's been underperforming compared to the other things that I talk about on this channel. Instead of investing in something high risk, possible high reward like an international or emerging market fund, I'd rather that money go into a high risk, high reward fund like a growth fund instead. There are also funds out there like VT that has the total world. You have a bunch of US and then you have a bunch of other countries as well. Some people like that one to invest in. And again, do the research and figure out what it is that you want or need from your investing portfolio. Next, I want to go over a couple other types of investments, but very, very lightly, and you can do more research to go deeper into any of these that sound pretty good. First is going to be cryptocurrency. And cryptocurrency is one that you either like or you don't like, but what I want you to do is do the best that you can to learn about it. I do believe that we're going to have this type of technology in our future, and we're going to be using it in some capacity. I'm just not sure exactly what. Out of all the cryptocurrency, I really only like Bitcoin at this point, and really can only see that application for it because of its truly decentralized nature. A lot of other cryptos just look like scams, and I would stay away from them. The best thing you could do right now is do your research. The next type of investment is something that I really like, which is real estate, but I just want to touch on a couple of things. Real estate will help diversify your portfolio, because if all you have is stocks or companies or ETFs even, you still are only in one type of asset class. We want to broaden that a little bit and get your money somewhere else, just in case the stock market in general drops. Hopefully real estate doesn't drop at the same time. Now you can invest in real estate in a couple of ways. One is super hands-off, which would be investing in REITs, which is kind of like a stock, but it's just purely real estate. I have a couple of videos on REITs specifically, and that's just a real estate investment trust. You get super high dividends, you get a lot of the benefits of investing in real estate without the headache of actually owning physical property. But then the other way to invest in real estate is owning that physical property, and that's how I choose to invest in real estate. I like having the actual asset right there. Specifically, I like long-term over short-term rentals, even though I've done both. But I like the idea of just a little bit more passive income, slow and steady. I don't need to make crazy profit every single month. I know that it's paying down the mortgage, and I'm able to get some cash flow, and it's helping me with some tax benefits. There's a lot of reasons to own property. One of the big ones, especially here in California where I'm at, is that price appreciation goes pretty high sometimes. One big con about real estate, especially physical real estate, is dealing with people and dealing with the government and just different things where it is a little bit of a headache. It's definitely not as passive as some of these YouTubers or bloggers will make it seem. You do have to put in the work, but I do believe that physical real estate is worth it if that's something that you want to go for. Next would be very, very safe type investing like bonds, CDs, T-bills, and even high yield savings accounts. For the most part, these are very, very stable. Your money shouldn't drop very much, if at all. especially in something like a high yield savings account where it's guaranteed, it's not moving with the stock market at all. With bonds, they're very safe, but you can lose a little bit of money, possibly. You could also make a bunch of money. All of these are really good because they produce interest or dividends, and so it makes it so that you have some cash flow either monthly or quarterly or when the bond actually matures. They're all different in nature, and so you'd want to dive a little bit deeper into each one, but one that I think that everybody should have is a high yield savings account. My favorite is Capital One just because I've used them forever. They're very easy, very customer friendly. The app is very, very updated, but right now it gives about a 4.25% interest, and so that's just a no-brainer, free money every single month. It's a much better place to be putting your cash than just in like a Wells Fargo savings account where you get 0.01% savings. The next thing that I definitely want to touch on is the difference between a Roth IRA and a traditional IRA, and just a couple things to keep in mind. Most people will say Roth IRA is number one, that's where you should be putting all of your money, blah, blah, blah. Great. I do actually believe that the Roth is probably the best account that most people should be putting their money into. I say most people because some people who are making a little bit too much might want to pull down their taxes by using some tax-advantaged accounts like a traditional IRA or their 401k or SEP IRA or something like that. But anyway, for the vast majority of people, putting money into the Roth IRA is so big because the big difference between the two is with the Roth IRA, you're taxed on the money that goes into the Roth IRA at that point, but then everything that it grows to and the compound interest that grows that thing like crazy, later on in retirement age, when you pull it out, you have zero taxes on it. It's not even reported as income at all. Whereas the traditional IRA is the opposite. You put the money in, you get a tax advantage now, so you'll get a better tax refund or your taxable amount is lower per year. But then later on, once it's grown to whatever it's grown to, when you pull the money out, now you're getting taxed then. So let's say that over a time period of 30 years, if you put in $100,000 or so of your own money and it grew to $1 million, that means that it's had $900,000 of growth. So you can either get taxed on the $100,000 that you put in, which would be the Roth IRA, or you can get taxed on the growth that happened, which is over $900,000, which would be the traditional IRA. When you look at it like that, it's a pretty big, obvious answer in my opinion, and I really like the Roth IRA. But both of them are important. Right now in 2024, if you're under age 50, the most that you can put in is $7,000 per year, and that's between the two. So if you have both, a traditional IRA and a Roth IRA, you can put $4,000 in one and $3,000 in the other, it's $7,000 total. If you're over age 50, then you can put $8,000 per year. I have a bunch of videos on how to start a Roth IRA, how to do it yourself. You don't need to pay somebody to help you do it. Check out those videos. Then there's obviously the 401k or 403b. And you probably have this at your work, and it's something where they offer it to you. You get to put a percentage of your paycheck away every single month, and hopefully they're matching it. I always recommend to people, if your company's matching it, let's say it matches up to 4% of your paycheck, take that match. That's free money. That's just extra money on top of your salary that you get to have. One thing that I would highly recommend is that you check what you're actually invested in within that 401k or 403b. I did a video on this especially where I showed you how to go through and actually change those allocations, because for the most part, you're probably in something that gives them a bunch of fees, and it's making it so that your retirement isn't growing as much as it possibly could. It's very easy to figure this out, but it is somewhat complicated without knowing what they're actually saying. So in that video that I just talked about, I go through it step by step, so check that one out later on. One big thing that I definitely want to touch on is that the idea is for any of these retirement accounts, it's great to be investing in that, and it's probably your best bet because you get some type of tax advantage either now or later on in retirement, but know that you can't really touch this money till age 59 and a half. There are some of you that are maybe in your early 50s and you have so much money in your 401k or 403b, and you could actually retire right now if you could touch that money. And some of you are frustrated because now you still have to work for another couple of years until you hit 59 and a half because you can't even touch that money without a 10% penalty. but I want to introduce you to the Rule of 55. The Rule of 55 is a provision in the US tax code that allows individuals to withdraw funds from their 401k or 403b retirement accounts without incurring the 10% early withdrawal penalty fee if they separate from their job in or after the year they turn 55. The 10% early withdrawal penalty is waived under the Rule of 55, but the withdrawals are still subject to regular income tax. You can withdraw as much or as little as you need, offering more flexibility in how you access your funds. So that's just a good little option for you. And so now I'm going to talk about something that's a taxable brokerage account, which is a great way to be investing, especially if you want to possibly live off your investments or retire early and just have a different option. Now, taxable brokerage is great for a lot of reasons. And basically, it's the exact same thing as having your Roth IRA or traditional IRA or even 401k, in that you're just investing. So you're putting some money in, buying companies or ETFs or whatever it is that you'd like, and then letting them grow, and at some point you can pull the money out. The difference here, though, is with a brokerage. Let's say you put money into NVIDIA or something, and in 6 months it goes up $300 or something, and you'd like to take that money out. You could sell it, take the money out. There's no 10% penalty. There's no anything for taking the money out early. The thing that you do need to know, though, is that you're going to be taxed. And the main thing that you need to understand is that you're taxed on the capital gain. So let's say that you bought this stock for $500 and it went up to $700. That means that you gain $200. When you sell it and you get all $700 out, you're only taxed on the $200, only on the capital gains. And there's different tax brackets, there's different types of taxes, if it's long-term versus if it's short-term. And again, I go over that in a lot of other videos, but the main thing that you need to understand is it really pays to be a long-term investor. Long-term capital gains tax is much, much less than short-term capital gains. Long-term just means that you held the stock for at least 1 year. For most people, the most optimal way to invest is to get something into retirement, something like at least maxing out the match that you get at your 401k, then getting a little bit extra into your Roth IRA if possible, and then if you have a little bit left over, then you start funding that brokerage account. And going a little bit further into taxes on investments, there's different types of taxes for different types of investments. One of the big things that I like to remind people is, let's say that you're invested in dividend stocks. You really like the idea of passive income and living off of a dividend that it spits out every single quarter. So let's say you have $100,000 in some account and you get about $1,000 every single quarter in dividends. But you don't need that money and you're just letting that $1,000 every quarter reinvest directly right back into the stock or ETF. So you never actually even touch the dividends. The thing is that you did receive capital gains. You did get more money, and now that money is being able to grow the investment even more. And even though you didn't touch it, you're going to be taxed on it and taxed into capital gains. So at the end of the year, you're going to receive a tax statement that says that you got this much in dividends. You're going to have to add that to your taxes, and you're going to pay taxes on that the following year. Now, on the opposite side, let's say just like from before, you bought NVIDIA or something and it went up a whole bunch. You bought $50,000 worth of NVIDIA and it went up another $50,000, and now you have $100,000 of this investment in your account. Well, if you never sold it, you didn't actually realize any of that gain, nothing actually happened other than the value went up. So you're not going to get taxed on that one until you actually sell. And then as far as your retirement accounts and taxes, the only time that you're going to get taxed on that is if you withdraw out of the account. And that would be for a regular 401k or 403b or a traditional IRA. Remember, with the Roth IRA, anything you pull out of that after age 59 and a half, you're not getting taxed at all. But within the retirement accounts, if you wanted to buy and sell or whatever it may be, within the account, as long as you're not taking the money out, say it's your 401k and you wanted to switch from some international funds to the S&P 500, you could sell within the 401k, buy up the S&P 500, and you won't get taxed. There won't be a penalty at all because you're not taking the money out. It's still staying within the 401k. It's just being reinvested into something else. There's also different types of taxes on real estate. There's different types of dividend tax, whether it be a qualified dividend versus just ordinary income. There's also taxes on business. There's different levels of taxes at different part of your income. And so one of the big reasons why I meet with people in my private financial coaching is to figure out and plan for these types of taxes and to figure out and make sure that you're in the right types of accounts, make sure that unnecessary things don't pop up. And so just like how I started this video, there's so many different things that have to do with your individual investing journey. And that's why it might be advantageous to meet with somebody that you trust and have them go over your plan and just have an extra set of eyes on it. Sometimes it's good to just talk out what it is that you're thinking, especially with somebody who's been doing this for a while. Find somebody that you trust, and if that somebody's me, I would love to meet with you. Email me at ProfessorG.invest@gmail.com. And speaking of retirement strategies, there's so many different things that you need to think about, which I kind of alluded to before. Basic rule of thumb for most investing is that one could live off of withdrawing 4% of their investment forever. The reason for that is, on average, hopefully your investment's going up 6%, 8%, 10% every single year. If you just got the market average of appreciation with dividends reinvested in the S&P 500, that's about 10% on average every single year. So if you were to take out 4% each year, technically you're actually still making 6% each year. So let's say that you need $40,000 in order for you to live comfortably. You need to take out $40,000 from your investment. That means that you will need to have invested at least $1 million sitting there, because 4% of $1 million is $40,000. You take out that $40,000, hopefully it still grows a bit, and actually at the end of the year you should have more than $1 million. And so next year, you can take that out again without it worrying that it's gonna drop a whole bunch. Obviously, there's a bunch of different things to consider there. You could do something like the dividend strategy, where you don't have to sell anything. Let's just say that you were getting a 4% dividend and you had $1 million. That would be spitting out $40,000 each and every year without you having to sell any shares of anything. That could basically keep you safe for the rest of your life if they never cut the dividend, and if that's what you need every year is $40,000, the principal will still be there, and then you're able to just give that whole thing over to your children or to charity or something else, and so that's a great strategy as well. Keeping in mind that you're probably going to get some Social Security, some of you are blessed enough to have a pension of some sort. There's a lot of different things as far as money that's coming in that people forget about during that retirement time. The other thing to consider too is the costs that you're gonna have to have during retirement. Things like medical expenses are much higher usually in retirement than they are right now. And especially if you don't have a job and you don't get insurance through that regard, then you're gonna have to pay higher insurance possibly. It could also be lower in retirement. There's also the tax strategy or retirement strategy of moving to a place that's a lot cheaper, downsizing a bit, and making it so that you're even more safe at that point. Having somewhat of a picture of what you want your retirement to look like is so important no matter what age you are, because it's going to help your investing now, and it's also going to bring down your stress level, so it's very important. And that leads nicely into the next section of how much should I be investing right now? If you've been listening and following along this whole way, it really has to do with what you think your retirement is going to look like and when you want that to be. If you want to retire in 10 years, it's going to look a little different than if you need to retire in 30 years. Or if you want to retire with $10,000 per month in income, it's going to look different than if you only need $1,000 per month. So understanding that is going to be the big thing here. You need to understand that compound interest is your biggest ally. The earlier that you get started in investing, the less money you have to put away each month in order to accumulate that big amount. One of the things that I did very early on was try to understand or figure out how much money I needed in retirement, or what would be a safe number. Then I got out just a compound interest calculator, or went to this website here, and you can just play around with the numbers. I always like to make the percentage that it's going to grow each year at 10%, just because that's what the S&P 500 has done for literally forever, with dividends reinvested. You can see what happens if you put $200 away for 20 years at 10%, and this is what it'll give you. Or you could see if you need to put away $500 a year at 10% for 20 years, and this is what it'll give you. And next is about portfolio allocation. So early on, the first thing that we talked about was what to invest in, or how many types of stocks and ETFs to invest in. And so hopefully at some point you figure out what your temperament or your risk profile or what you care about and how you'd like this thing to even look like. Maybe we do a private financial coaching session and we figure that out together. And then at that point, we could say, okay, how much percentage should be dividends? How much percentage should be the S&P 500? How much percentage should be fun, crazy stocks like Nvidia and Tesla or growth ETFs? And then where does Bitcoin or real estate or whatever, where do those fit in? And again, this is going to be different for each person, but generally the closer that you get to retirement, the more safety you're going to want. Because once you get to a point like age 65 or 70 and you're like, I don't want to work at all anymore, that means you don't have an income coming in to keep you safe. So if all you're doing is living off your investments, and let's say that you have $1 million, but the stock market drops 20%, now you only have $800,000. And if it drops 20% again, now your money's really, really in jeopardy. And so what we want to do is we want to get a good healthy portion of that portfolio in super safe and stable, either stocks, bonds, high yield savings account, different types of strategies so that you can weather the storm of a stock market dropping and make it so that you can live forever, stress-free, be totally fine with that actual money. So portfolio allocations really have to do with your age, your risk profile, and what your overall goal is. We definitely rebalance these types of things yearly or every couple years, depending on the economy, depending on new life status, depending on new goals or new things that come up. So all this is important to keep in mind when you're figuring out what is the percentage of what that goes into your portfolio. So now how do we put all of this together? The first thing that you need to do is kind of what I talked about from the beginning, which is figure out your numbers. Figure out your numbers now, your budget. Try to figure out how much money you have left over each month and what are you doing with that money. Hopefully you have a high yield savings account already that's like an emergency account so that if anything crazy comes up, you can pay for it there and you don't have to take it out of any of your investments. Hopefully you're already investing within your 401k and maybe have a Roth IRA set up. Hopefully you're starting a brokerage account or have that going. At some point trying to figure out what is your actual risk profile and understanding what are the taxes and the tax implications here, and then trying to figure out, okay, but what does all this mean and what am I trying to do at some point and what does my retirement look like, or when do I want to retire and how can I retire earlier? Once we have all those variables figured out, then it's just as easy as making sure that you continue to invest strong and keep your expenses low. Keep consumer debt or credit card debt or anything like that to a minimum, and then just keep investing simplified. Don't overcomplicate it and keep your emotions steady as much as possible. There's always going to be a fear of a recession or something crazy that's possibly going to happen and everybody should sell their stocks. Do your best to stick to the plan, stay the course, and keep investing simplified. I know this was a long one, but I'm a professor and I'm used to talking for an hour or two at a time, so it wasn't that crazy for me, but I would love to hear your thoughts down in the comment section below. Reach out to me by email, and I'll see you on the next one. For those of you that want a little bit more information on the 3-fund portfolio that I recommend, check this video out. And if you already know all about that one and are already investing in that and love it, check out this video. Keep you going strong.